back. So, let us continue from where we left off. We now address the common misconceptions about the EMH and we try to respond to those criticisms. The EMH questions the ability of investors to consistently detect mispriced securities. This implication does not agree very well with many financial analysts and active portfolio managers. Arguably, in liquid markets with many participants such as stock markets, prices should adjust quickly to new information in an unbiased manner. However, much of the criticism levelled at the EMH is based on numerous misconceptions and incorrect interpretations about the theory of efficient markets. Let us now address those misconceptions. The first misconception is that EMH claims that investors cannot outperform the market, yet we can see that some of the successful analysts such as George Soros, Warren Buffett and Peter Lynch are able to do exactly that. Therefore, EMH must be wrong. In fact, the EMH does not imply that investors are unable to outperform the market. It is possible that an investor could make a killing if newly released information causes the price of the security the investor owns to substantially increase. What EMH does claim, however, is that one should not be expected to outperform the market predictably or consistently. It should be noted though that some investors could outperform the market for a long time by chance alone, even if the markets are efficient. Let us take an example. Imagine, for the sake of simplicity, that an investor who picks stocks randomly has a 50% chance of beating the market. Let us assume this. For such an investor, the chance of outperforming the market in each and every of the next 10 years is then given by 0.5 to the power 10 or about 1/10 of 1%. However, the chance that there will be at least one investor outperforming the market in each of the next 10 years sharply increases as the number of investors trying to do exactly that increases. In a group of 1000 investors, the probability of finding one ultimate winner with a perfect 10-year record is 63%. With a group of 10,000 investors, the chance of seeing at least one who outperforms the market in every one of the next 10 years is 99.99%, almost a certainty. Each individual investor may have dismal odds of beating the market for the next 10 years, yet the likelihood of, after the 10 years, finding one very successful investor, even if he is investing purely randomly, is very high if there are a sufficiently large number of investors. The existence of a handful of successful investors, therefore, such as Messrs. Soros, Buffett and Lynch, is an expected outcome of a completely random distribution of investors. The theory would only be threatened if you could identify who those successful investors would be prior to their performance rather than after the fact. Misconception number 2. EMH claims that financial analysis is pointless and investors who attempt to do research on security prices are wasting their time. Using completely random methods will produce a portfolio that can be expected to do just as well as any managed by professional security analysts. Yet we tend to see that financial analysts are not driven out of the market, which means that their services are valuable. Therefore, EMH must be incorrect. The answer to this misconception or the response to this misconception is very intriguing. Financial analysis is far from pointless, inefficient capital markets. The competition among investors who actively seek and analyze new information with the goal to identify and take advantage of mispriced stocks is truly essential for the existence of efficient capital markets. In fact, one can say that financial analysis is actually the engine that enables incoming information to get quickly reflected in security prices, because it is their analysis that enables them to make rapid trades. The rapidity with which they are able to identify mispriced securities when new information percolates into the market is the and reduces the response time. The faster is the response of the investors or the analysts in identifying mispriced securities and taking action, the faster would be the response time of the market recovering to a new equilibrium level. So, why don't all investors find it optimal to search for profits by performing financial analysis? This is a good question. The answer is simple. Financial research is very costly. In addition, analysts who frequently trade securities incur various transaction costs, including brokerage, bid ask spreads, and market impact costs. Therefore, any profits achieved by the analyst while trading on mispriced securities must be reduced by the costs of financial analysis as well as the transaction costs involved. In general, the advantage gained is not sufficient to outweigh the cost of their advice. In equilibrium, there will be only as many financial analysts in the market as optimal to ensure that on average the incurred costs are covered by the achieved gross trading profits. For the majority of other investors, the chasing of mispriced stocks would indeed be pointless, and they should stick with passive investments such as with index mutual funds. Misconception number 3. EMH claims that new information is always fully reflected in market prices, yet one can observe prices fluctuating sometimes very dramatically every day, hour and minute. Therefore, EMH must be correct. Let us see the response. In fact, the constant fluctuation of market prices can be viewed as an indication that markets are efficient. New information affecting the value of securities arrives constantly, causing continuous adjustment of prices to information updates. In fact, observing that prices did not change would be inconsistent with market efficiency, since we know that relevant information is arriving almost continuously. Misconception number 4. EMH presumes that all investors have to be informed, skilled and able to constantly analyze the flow of new information. Still, the majority of common investors are not trained financial experts. Therefore, EMH must be incorrect. The response is, this is an incorrect statement of the underlying assumptions needed for markets to be efficient. Not all investors have to be informed. In fact, market efficiency can be achieved even if only a relatively small core of informed and skilled investors trade in the market, while the majority of investors never follow the securities they trade. So, this is all about the efficient market hypothesis. And just taken it up in a lot of detail. I hope the learners find it useful. We now move to the final topic of this course, which is financial derivatives. Now, why I have confined only about 3 lectures to this course is that there are 2 courses which are running parallel with this semester's course on security analysis and portfolio management. There is a course by Professor Praveena Rajiv of IIT Kharagpur on commodity derivatives, and there is another course on financial derivatives, which is a rerun course of mine. So, the learners that are interested or intrigued by the concept of financial derivatives, want to learn it in detail, can register or enroll for any of these 2 courses. They will find them much more informative. At this point, I will simply give you a visual of what the financial derivatives looks like and what are the relevant the nuances that are associated with financial derivatives. So, let us get into them. I have given you a brief touch on financial derivatives in the introduction section of this course, but let us develop that part. So, what is a financial derivative? A financial derivative is an instrument whose value depends on or is derived from the value of another asset. For example, we have forwards, futures, options, swaps, future options, etc. So, basically a financial derivative is a financial instrument. The price of which or the value of which depends on the price or value of some other asset. And that other asset is called the underlying asset, and that other asset may be an index, may be a stock index, may be a single stock. For example, derivatives on RIL, derivatives on Tisco and so on. It may be a commodity, for example corn, maize, wheat. It may be real estate, it may be interest rates like interest rate derivatives. So, it could be there is a huge variety, a huge set of assets which can form or on which derivative contracts have been written and are being traded. So, basically to reiterate, a derivative is a financial instrument the price of which is determined or is associated or is linked to the price of another financial asset. Common applications of derivatives, we have speculation where a naked position is taken in the derivative just like a naked position in any other asset, and the investor who takes this position hopes to beat the market, hopes that his perception of the future price movement of the asset would be different from the market perception, and it is his perception which is likely to realize, and thereby he would make a profit or he anticipates making a profit. Hedging is a situation where we already have an exposure and we want to curtail that exposure. In other words, we have an exposure whereby some risk factor, when it impacts that exposure, it could result in a price change or a value change which is detrimental to us, and by taking a position in the derivative we want to reduce or eliminate the impact of that risk factor in adversely affecting the price or value of our exposure. Arbitrage is a situation where different prices of similar assets or same asset exist in different markets, and whereby by taking opposite rates we can make a riskless profit. Changing the value of assets and liabilities, well, this is typically demonstrated by the interest rate swaps where fixed rate borrowing is converted to a floating rate borrowing and vice versa. Common varieties of derivatives I have already mentioned: forward contracts, futures, options and swaps, and then we have multiple combinations of these derivatives. We have future options and so on. Even options we have a huge variety. So, that is obviously beyond the scope of this course. Now, talking about forward contracts, what are forward contracts? Firstly, forward contracts are customized contracts. We have two relevant dates in the context of the forward contracts. We have today, which is the date on which the contract is negotiated, that is t equal to 0. The price is agreed upon at t equal to 0. All the other terms of delivery are agreed at t equal to 0. In fact, all the terms that are required for an unambiguous settlement are agreed upon at t equal to 0, including price, delivery terms, delivery instructions, the quality of the underlying asset. Everything is agreed at t equal to 0, but the actual settlement of the contract, the actual delivery of the underlying asset and the payment of the price therefore takes place at the future date. That future date is also agreed upon at t equal to 0. In fact, that is called the maturity of the forward, that is predetermined. However, the settlement of the contract, as I mentioned, takes place on a specified future date. Specified, please note that it is also agreed at t equal to 0. The settlement date is also agreed today. Cash flow occurs in the future. No cash flow occurs at the point of negotiation of the contract. Of course, bankers may require certain amount of deposited by way of margin in the form of fixed deposit receipts or some other form of deposit, but that does not pertain to the direct nexus. That does not have a direct nexus with the forward contract. That is in relation to the possibility of default on the forward contract. Since forwards are private contracts, the susceptibility of default exists, or the possibility of default exists. Futures contracts are slightly different. Futures are in a sense they are similar to forward contracts in the sense that they are also contracts which have two relevant dates at t equal to 0, at which all the terms in relation to the settlement at t equal to capital T, which is the maturity, are agreed upon. The date of maturity, the price at maturity, and the terms of delivery, the quantity and the what you call and the method of delivery, everything, the method of settlement of the contract. If it is to be cash settled, for example, everything is agreed at t equal to 0, and the actual settlement of the contract is at t equal to capital T, the maturity of the futures contract. So, to that extent they mimic absolutely the forward contract. What is different though is are two fundamental properties: the fact that they are tradable and the fact that they are now, the fact that they are tradable in fact results in two properties. Number one, that they are standardized, so that there exists adequate liquidity in the market, and number two, there is a proper risk management mechanism, so that the performance on the futures contract is default free, because if there was a default risk in the futures contract, it would inhibit trading, and therefore a mechanism is put in place to eliminate any risk of default. We will come back to it. So, since futures are exchange traded, they are standardized to facilitate liquidity. To enable uninhibited trading, the exchange is clearing out guarantees performance of both legs of these contracts. These contracts carry negligible default risk. The exchange protects itself by imposing MTM and margining. So, I will talk about MTM and margining at a later point in time. So, forwards versus futures: forwards are private contracts, forwards are customized, forwards carry one specified date. Usually forwards are settled at maturity by delivery or cash settled, usually by delivery. Forwards carry some credit risk. Futures are exchange traded contracts. Futures are standardized. Futures may carry one or more of a range of specified delivery dates. Futures are settled daily by marking to market. Futures are usually closed out before maturity. Futures carry virtually no default risk. Now, we talk about option contracts. Now, you see, in the case of forward contracts and in the case of future contracts, there exists once the contract is agreed upon, and once the contract is negotiated at t equal to 0 and agreed upon, then both the parties have their respective obligations. Party A, for example, is required to pay the certain amount of money, and party B is required to deliver the underlying asset to party A. So, there are obligations on both the parties insofar as the contract or the execution or the settlement of the contract is concerned. However, when we talk about options, it is slightly different. Again, we have two parties, but in this case one party has the right and the other party has the obligation. Let me repeat, one party has the right either to buy or sell the asset at a predetermined point in time at a predetermined price, both of which are agreed upon at t equal to 0. So, one party has the right either to buy or to sell an asset at a future point in time at a price which is agreed upon at t equal to 0. Both the terms, the maturity as well as the price, are agreed upon at t equal to 0. But the other party, this is the fundamental difference, the other party has the obligation. If the party A exercises the right that he is invested with by virtue of buying the option, the party who has sold the option has the obligation to deliver the asset. If it's an option to buy the asset, or to buy the asset if it's an option to sell the asset. So, the basic thing is that in the case of an option contract, the difference between this and forwards or futures is that one party has the right, the other party has the obligation, and therefore, because one party is at a superior pedestal, the other party is at a lower pedestal. He has a right, he has no right, he has the obligation. Therefore, the party who has the right must compensate the other party by a certain price, which is called the premium on the option, or which is the price at which the option is bought. The party who has bought the option contract is said to have the right, or is the party that has the right. The party who has sold the option is said to or have the obligation, or has the obligation rather embedded in the option contract. So, option contracts are contracts whereby the holder of the option acquires a right to buy or sell a certain asset by or on a certain date for a certain price. All this is pre-agreed, and I reiterate that this is a part of the option contract which is initiated at t equal to 0. The seller of the option has the obligation to honor the option if the holder is the buyer of the option, that is the holder of the option, that is also called the party long in the option. The seller of the option is called the writer of the option, is also called the party short in the option. So, the seller of the option has the obligation to honor the option if the holder decides to exercise the option, he has no discretion. The discretion rests with the buyer of the option. He may exercise the option, he may let the option lapse. Of course, if he lets the option lapse, he loses the premium, but that discretion is vested in him, that he can allow the option to lapse, or he may exercise the option and impose the right embedded in the option contract. The seller of the option has the obligation to honor the option if the holder decides to exercise the option. He has no discretion. Option contracts that give a right to the holder to buy or sell the underlying asset are called calls or bracket puts. So, the right to buy is called a call option, the right to sell is called a put option. If the option buyer, if the option holder, or if the party long in the option has the right to buy, or the option contract embeds the right to buy an asset at a predetermined price on a predetermined date, it is called a call option. And if the contract has a right to sell, and it is called a put option. Swaps are private agreements between two parties to exchange cash flows in the future according to a prearranged formula. They can be regarded as a portfolio of forward contracts. Common swap contracts are interest rate swaps, which I alluded to a little bit earlier, and currency swaps. So, now we talk about forward contracts. What is the terminology in relation to forward contracts? The underlying asset is the asset which forms the substratum of the forward contract, which is the asset that is to be exchanged under the forward contract. The party who is long in the forward contract will buy the asset from the party who is short in the forward contract. Which asset? That asset is called the underlying asset. Maturity, the date on which the forward contract matures for execution, or the date on which the contract is to be settled. I repeat, this date is also fixed at t equal to 0. Forward price is the price at which the forward is to be settled. It is the price that is agreed upon at t equal to 0, but the actual payment of the price takes place on maturity. Long and short positions. Now, quickly let me refer to this technical terminology. Underlying asset, insofar as long and short positions in the underlying asset are concerned, a long position in an asset means owning the asset, shorting the asset means borrowing the asset. As far as the forward is concerned, the entity who buys the asset under the forward contract, buys the underlying asset under the forward contract is said to be long in the asset. The party who delivers the asset under the forward contract is said to be short in the forward contract. So, as far as the option is concerned, the party who buys the right is said to be long in the option, the party who sells the option is said to be short in the option. The forward price, the value of a forward contract at the point of inception is invariably 0. Now, here I want to make a slight digression. I need to tell you the difference between the value or the forward price or the value of the forward contract. Now, as far as the forward price is concerned, it is quite simple. Just like we have the spot price, we have talked about it in a lot of detail. What is the spot price? The spot price is the price that you pay when you go to the market and buy an asset. You pay the price, you buy the asset. That's the spot price. Now, as far as the forward price is concerned, what happens? You and I agree today that I will deliver you a certain amount, a certain asset, say 3 months down the line, at a price which is agreed upon right now. This is called the forward price. The price that is agreed upon at the inception of the contract, at which the delivery is likely to take place. Delivery is supposed to take place on the date of maturity of the forward contract. But there is a certain thing called the value of the forward contract. Now, the value of the forward contract, suppose today you and I enter into a forward contract. For example, I am to deliver against this forward contract, you are to deliver me $500, I am to pay you say 50,000 rupees. And say at the end of 3 months from now. At this point, the value of this contract is 0. Both of us have agreed upon this today, and at this point the value of the contract is 0, because this 50,000 rupees for $500 would pretty much reflect the current rate, market rate, in the context of delivery at the end of 3 months. So, at this point, this is the forward price. This is called the forward price. However, as we move forward in time, say tomorrow, day after tomorrow, 15 days down the line, 1 month down the line, the market perception about the exchange rate between US dollar and Indian rupees will change, and as a result of which, maybe the dollars would become dearer, or maybe the rupees would become dearer and you have to pay less rupees for the dollar. That would cause the contract that you and I have entered into at t equal to 0 to acquire a certain value. In other words, if either of us was to get out of the contract and assign it to a third party, then the price or the amount of money that the third party would either receive or pay depending on who is exiting, and the new relationship between new exchange rate is called the price of the forward contract or value of the forward contract. So, there is a difference between the forward price and the value of the contract. The value of the contract is a value ascribed to the composite contract comprising of both the legs, and when there is a transfer of the contract or the assignment of contract from one party to another. However, as far as the price is concerned, it is the price that one party pays for acquiring the underlying asset under the forward contract, and obviously this price is determined by the market, and as is indeed is the price or the value of the forward contract. So, that is the difference between the value of the contract and the forward price. We shall talk about quickly, we shall talk about how the forward value of a forward contract is determined. So, the forward price of a contract is the delivery price that would be applicable to the contract if it was negotiated today. That is, it is the delivery price that would make the contract worth exactly 0. Now, why are forward derivatives? Well, as I mentioned, depending on the carrying forward the example that I mentioned just now, as time passes, say t equal to 1 day, 2 days, 15 days, 1 month, the perception about the exchange rate between US dollar and Indian rupee changes, and as a result of which the contract that you and I have entered into acquires a value. That means what? That means this contract, forward contract, is acquiring a value based on the changes in exchange rate. As the exchange rate changes, this contract will acquire either a value for me and a value for you. Of course, it's a zero sum game. So, the point is as the exchange rates change down the line during the life of the forward contract, the value of the contract changes, and that is why this forward contract is classified as a derivative contract. Why? Because the value of this forward contract is dependent on what? Is dependent on the exchange rate that prevails in the market at any point in time. Now, payoffs and payoff diagrams. Now, you see, the point is the date of maturity of all these derivative contracts is in the future, and as you know, prices are not absolutely predictable insofar as future is concerned, at least for most of the assets. You may have a risk free bond, but other than that, prices of most of the financial assets are not absolutely predictable as on the date of maturity of the derivatives. They are in fact random variables. Now, that being the case, what we try to do is sitting here at t equal to 0 or at any earlier point in time between t equal to 0 and t equal to capital T, which represents the maturity of the derivative, we want to assess or evaluate what kind of payoffs we are going to get or what kind of money flow is likely to take place on the date of maturity of the derivative contract. This is captured by something which is called the payoff profile or the payoff function. The payoff function or the payoff profile, as you may say, is the payoff profile is the graphical representation and payoff function is the mathematical representation of the flow of money or the relationship between the price of the underlying asset on the date of maturity of the derivative, which is a random variable, and the excess price or the price at which the derivative is to be settled. So, let me repeat, the payoff profile or the payoff diagram or the payoff function are representations either graphical or mathematical of the relationship between the various possible values or the spectrum of values that the underlying asset, the price of the underlying asset could take on the date of maturity of the instrument, and the payoff from the or the excess price of the derivative. So, these are called payoff functions. You will take examples of them in the following slides. Now, this is the payoff of a asset position, pure asset position, naked asset position. Suppose you are long in a particular asset. Suppose you bought the asset at S0, you bought the asset at t equal to 0 at a price S0, and let us say on the date of maturity the price is ST, where ST is obviously a random variable. Then the profit from the asset that you are going to get is ST minus S0, which is what you see here in this left hand side panel, which is in the left hand side panel. It depicts ST along the x axis and the profit, that is ST minus S0, along the y axis. Clearly it is a 45-degree line, and if the value of ST turns out to be 0, the entire S0 is a loss, and which is represented by the y-intercept. Similarly, for a short asset, it's a mirror image, because long and short positions are basically a zero-sum game. So, as far as the depiction of the long and short positions are concerned, they are mirror images of each other. Now, as the payoff diagram of a long and short forward. Now, as you know, the forward contract entails the delivery of the asset at a fixed price, which is determined at t equal to 0. Let this price be k. Let this price, or the underlying price, or the forward price on the date of inception of the forward contract, be k, which is to be paid, say, at time capital T when the forward matures for getting the underlying asset. Now, this underlying asset, when I acquire this underlying asset under the forward contract, I can sell it in the market. I can sell it in the market at what price? I can sell it in the market at the price S capital T. Therefore, S capital T minus K would be my profit, or would be my net cash flow under the forward contract. So, this graph represents that particular situation if I am long in the forward contract, and obviously if I am short in the forward contract, the mirror image would be the graph or the payoff diagram of the short position. It would be K minus ST. Here we have ST minus K for the long forward position. So, I will acquire the asset at K, I will sell it in the market at ST, I will make a profit, or the net cash inflow to me would be ST minus K, which is represented by the left hand panel. And if I am short in the asset, then I will have to deliver the asset at K, I have to buy the asset at ST. So, my net cash flow is K minus ST, which is represented in the right hand side panel. Now, we talk about no arbitrage pricing of forward contracts. Let us look at the simplest case. In the simplest case, what we assume is that there is no income from the underlying during the forward, no carrying cost of the underlying during the period, no transaction costs and other market frictions. So, let us now look at a situation. Let us say we are at t equal to 0, and let us investigate the situation what will happen at t equal to capital T, which is the maturity of the forward contract. Let us assume that I do the set of transactions which are represented in the left hand column. I borrow a certain sum of money, which is S0. Borrowing this sum at the risk-free rate from a bank or a financial institution or other lender at the risk-free rate, I borrow an amount S0. What I do with this S0 amount of money? I buy 1 unit of the underlying asset. So, if the market price of the underlying asset at t equal to 0 is S0, then I pay S0 and I buy the asset in the spot market by paying this S0 and getting 1 unit of the underlying asset. At the same time, what I do, I take a short position in the forward contract on 1 unit of the underlying asset that I bought at S0. In other words, I take a short position on the asset which I have bought already by paying an amount S0 which I have borrowed from the bank. So, now, please note, as I mentioned, in the case of a forward position or taking of a forward position, there is no cash flow at t equal to 0, and therefore, that is represented at t equal to 0 by 0. What happens at maturity? At maturity, what will happen? I will deliver the asset under the short forward contract, and I will receive the price of the asset, which is K, which is I will receive the forward price of the asset, please note this, which is K, which is agreed upon at t equal to 0 when I enter into the short position in the forward contract. So, my net flow at t equal to capital T, that is the maturity of the forward contract, will be K minus ST or F0 minus ST, as assuming that we represent K by F0, which is the forward price at t equal to 0. So, the cash flow on account of the short forward contract is F0 minus T. I receive the money, and if I have to buy the asset from the market, I will have to pay ST and receive F0. Now, what about the money that I have borrowed? Now, I have borrowed an amount S0 at t equal to 0, I have to repay that amount together with interest. So, that will become what? That will become S0 exponential RT. So, this is the amount that I have to repay to the bank against my borrowing of S0. And what about the asset, 1 unit of the share, 1 unit of the asset that I have already bought at t equal to 0, I can sell it in the market at ST, or equivalently I can use that 1 unit of the asset to deliver it under the forward contract. Either way it comes to the same thing, because we are ignoring transaction costs. We assume that the transaction cost is 0. So, either I use that 1 unit of the asset that I have with me to deliver it against the forward contract and receive the money F0 from the other party who is long in the forward contract, and so I have an amount F0 with me, or I can also sell this underlying asset in the market and then buy the underlying asset and deliver it under the forward contract. Either way, the net cash flow remains unchanged. So, the overall situation that arises at t equal to capital T is the net cash flow is F0 minus S0 exponential RT. Now, look at the two situations. Number 1, at t equal to 0, there is no cash outlay. Number 2, we have assumed that the forward is default free. We have also borrowed at the risk free rate. So, the net result is that there is no incremental risk arising from this set of transactions. There is no additional risk taken by the party or the arbitrager who is indulging in this transaction. Therefore, the cash flow at t equal to capital T must also necessarily be 0. I repeat, number 1, there is no cash outflow at t equal to 0. Number 2, we are not taking any risk in this process. We are not taking any incremental risk under this set of transactions represented at t equal to 0, assuming that the forward is default free, and therefore, the net cash flow at t equal to capital T must be 0, and that gives us the no arbitrage value of the forward contract at t equal to 0, as F0 is equal to S0 exponential RT. We shall continue from here in the next lecture. Thank you.